The 20th annual Stansberry Research Conference is coming up. I'll be presenting as well as mingling with subscribers at lunches and dinners. The biggest and brightest financial minds will be in Boston for 2 days of ideas and actionable stock recommendations, covering cryptos, big tech, precious metals, real estate, gold, and so much more. These conferences are truly the most unique business mixed with pleasure industry events out there. I'll be there, but will you? In this volatile, confusing market that we're in, you'd be smart to talk to other like-minded investors and hear all the stock picks. Just one successful idea shared on stage can pay for your ticket and then some. And if you're not up for the trip to Boston this year, we've got a discounted live stream option. Same brilliant presentations from the comfort of your own home. Go to McCallStansberryBoston.com for all the details, including a speaker lineup, past conference stock winners, hotel pictures, and how you can get your free $1,000 gift just for signing up. Again, that's McCallStansberryBoston.com. Be sure and register while they still have tickets left. Come find me in Boston and make sure to shake my hand. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is the 28th of June, 2022. A beautiful Tuesday here in Baltimore, back in the home studio, as you all can see. Big show coming up. We're going to talk about the last 6 months, what's really led to these talks of recession, what led to the bear market. Also, more importantly, you don't drive a car in a rearview mirror, you look ahead. We're going to look ahead at the next 6 months and what could drive the market. And 2 charts, I'm going to show you why I believe we have a big rally in store in the next 6 months. And then there's one sector I think you really need to look at. More and more research I do, the more and more I like it, and that's the financials. I don't talk about them very often, but I have a couple stocks you need to put in your watch list. All that and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It's June 28th, 2022. Again, here in beautiful Baltimore in the home studio. It feels so good to be here. Actually got a good night's sleep. I'm feeling really good today. It's the most sleep I've had in many, many years. I felt like it. Went for a run after work yesterday. Got a good meal, good sleep. We're ready to go. We got a big day ahead of us. So I want to talk about the markets a little bit, obviously, and I want to talk about Bitcoin. You just mentioned that. Then, as I mentioned, we want to talk about the last 6 months, look ahead to the next 6 months. A couple of charts that I think are really going to just blow your mind when you see them. And then a couple of financial stocks, not necessarily the big ones, a couple of big ones, but some smaller ones you may have never heard of that I really believe are setting up for a real big rally in the next 12 months. And we'll talk about why. It's all about 1994. It's about the year I graduated high school, folks. That's why. All right, first, let's jump into the markets. And I want to take a look. Let's take a look right here at the S&P 500. We're taping this a little bit before the market opened, so we're about 15 minutes before the market opened. And we're up a little bit this morning, about 0.3%. Futures are. But as you can see here, we've in this pattern, and this pattern is really important because if you take a look here, we had this rally in March, which failed. We had a bit of a bounce in April, it failed. Another one in April, later April, one in May. Now we're having this bounce in June. And you can see, you can just draw a line right here connecting these. And that is a downtrend. And a downtrend is a series of lower highs and lower lows, which we have on the downside. If this trend were to continue, it means the S&P probably falls down about 3,400. This trend, you have a lower low. I'm not saying it's going to happen. I'm not saying it's not going to happen. If I had to put odds on it, I said maybe about a 30% chance that happens, 70% chance that we put the bottom in about 2 weeks ago. But this level is very important. On the SPYs, it's right around 390, 395 level. Ideally, you get above 405, and it's really going to be a nice breakout. You're breaking definitely the downtrend line. And then above there, about 417, that would be complete confirmation that a bottom has been put in. I just don't see a V-shape like we had after COVID. After COVID, we fell like this and had a V-shaped recovery that lasted, several, basically a year and a half. And it more than doubled the S&P from that time frame. I don't foresee that. I think we're going to have a really nice next 6 months. I don't foresee that yet, but the next couple of weeks will be telling in this area between 390, 405-ish. That's going to be very important on the SPYs. Those are the levels, folks, you need to be watching. So that's where we stand with the markets right now, kind of in no man's land. That being said, and I said this about a month and a half ago, there are several stocks out there, and I talked about a few of them at the time, that I believe have bottomed and I believe are not going to see that low that we've seen earlier this year again. Maybe never. Some of these stocks got beat up that much. that I think that is their ultimate low going forward from here. So first, let's take a little bit of a look back, walk back in history, if you will. And history is just basically the last 6 months because we are just a few days away from wrapping up the first half of the year in the second quarter. So we had obviously the big word that we talked about is recession. And I feel like everybody's talking about the R word right now. Everybody believes that recession is almost inevitable. Debate right now, is it going to be a shallow recession, meaning that the economy only slows down a little bit, or will it be a deep recession? Jim Rogers, who made a call decades ago and has been basically living off that call, he started a hedge fund, George Soros, back in the day. They crushed the market in the first 10 years. They crushed it. Since that time, he's made some okay calls, but he's made a lot of wrong, big calls. I'm not just saying little things, but some big calls. He's been very wrong. He's historically a pessimist. Howard Marks, another big fun guy, he came out recently and said this is a great buying opportunity. And he's been negative for several years. So that's kind of interesting. But Jim Rogers thinks he's going to see the biggest pullback in his lifetime. The guy's in his 70s. I think that's absolutely absurd. I don't see a deep recession coming. Remind you, a recession is 2 consecutive quarters of negative GDP prints. Last quarter, we had a negative GDP print. It was very slight. It was less than 1% on downside. If we have another one, technically in a recession this quarter. I don't think we're going to see it, but it could happen. You never know. And again, that's a very shallow recession. And I believe the market's already priced that in with the bear market that we have seen. So recession's been a talk of the last 6 months. Obviously, that has led to the next topic, bear market. Now, we went into a bear market in major averages. NASDAQ's down over 30%. Again, in bear markets, when the stock pulls, or market or stock pulls back at least 20% from a high. S&P still sitting in bear market territory. Obviously, the NASDAQ still is as well. Russell 2000, small mid-cap index, still sitting down there as well. So we've had the bear market. We've also had the crypto winter, and that means when, we've had several what they call crypto winters, and that's when Bitcoin and cryptocurrency markets get crushed down over 50% or so. Bitcoin's still down about 70% from the high. Remember, we hit a high last year around 69,000. Right now, we're trading around 21,000. We fell below 18,000 about a week and a half ago. So could that be the ultimate low? I don't know. I have some very smart people that I surround myself with that thinks it can still go lower. As many of you know, that's one of my large holdings. I continue to hold. I haven't bought any recently because I have a large holding already. But if it gets down into teens or so, I'll probably be a very aggressive buyer down there. If not, I'll be happy with what I have and ride it back up. But I'm still very positive on Bitcoin and cryptocurrencies going forward over the next couple of years. Employment's a very tricky one because we have unemployment near historic lows. But at the same time, you're seeing a lot of large firms, especially in tech space, not only going on hiring freezes, but laying people off. And there's a lot of rumors right now that Wall Street is expecting a bunch of layoffs for their investment bankers and brokerage advisors and everything on Wall Street. So I think that will happen. What happens is, sectors that do really well and industries that do really well, as the banks did very well. They actually, during COVID, they actually did well. There's a lot of SPACs going on, a lot of IPOs coming out after the bottom of COVID. They went on basically a hiring spree. And what happens is you hire so many people, then you realize, oh boy, we hired too many. We're human beings, right? I talk about that pendulum going from one side to the other. You get overly excited, hire too many. If they trim a little fat, get down here. And there's a lot of companies that could trim some fat. And that's actually sucks for the person who's getting laid off. And I wish nobody had to get laid off. But if you're looking from a pure financial stock market sense, trimming some fat actually lowers expenses. And it can be very good because a lot of the companies can continue to perform and generate the exact same amount of revenue with less people, less fat, less expenses. So I don't think that's the worst thing in the world. Keep in mind, a big reason why I think this is going to happen, I mentioned IPOs and SPACs. The IPO market so far this year is down 91% from a year earlier. That generates a lot of money for Wall Street. So they're not getting that revenue from that. So that's, I think, one big reason you're going to see that. Also, first 6 months of the year was the 2 I words. Interest rates, obviously, Fed started raising interest rates. We had the interest rate on the 10-year Treasury hit 11-year high, close to 3.5%. And all the other I word was obviously inflation at a 40-year high, up around 8.5%. So that was driving the first 6 months and led obviously to bear market and recession talks. So that's kind of where they all get tied together. More importantly, again, you don't drive a car in a rear view mirror. You drive your car looking ahead. You can't do that. It's not going to, you're going to crash, right? So looking ahead, there's a few things that I'm looking at. One is a potential housing slowdown, and two reasons really why this will be. One is going to be the rise of interest rate leading to mortgage rates being at the highest level in a decade. I mean, a huge spike up in interest rates, which if you're looking at a home, a $300,000 home, let's say, and the beginning of the year you were borrowing at two and change, and now you're borrowing at 6%, you can afford much less house. Because if that was your max out, or you're going to be paying a lot more for that $300,000 home. If you want to have the same payment, you're dropping down to a house in the low 200s. So that's really kind of scaring people away. And at the meantime, prices keep going higher in houses, and it makes affordability an issue. So the rising interest rates leads into affordability. The affordability for home buyers right now is one of the lowest that we've seen, or worse, let's say, call it the worst we've seen in many, many years. So affordability is becoming an issue, and I think that slows down the bidding wars for homes, and then that will be good because I think you need to come back a little bit in housing prices, let the average person get back into homes and into potentially buying their first home or upgrading a home. So I think that that will actually end up being okay. And the one area to think about is if that does slow down, what do people do if suddenly they're not buying homes? They say, you know what, we'll make the home we have work. Maybe put an addition on, maybe redo the bathroom, the kitchen, whatever it might be, rip out the floors. And that could bode very well, in my opinion, for some of the home improvement stores. Obviously, the big ones out there, Home Depot. We'll take a look at that stock for you real quick. You take a look at a chart here of Home Depot. It was up around $420 a share late last year, fell down around 265. We're at 283 now, so well off the high. But I want to show you a long-term chart here of Home Depot. You see, I mean, it's had pullbacks like this along the way. It's had these, and it's been able to bounce back every time. And really, you're right back to where you were in 2020. So it's not like we've wiped out years and years of gains. I think right around here, this 260, 280 level is very interesting when it comes to Home Depot. Lowe's is the other big name out there. Again, that's their long-term chart, very similar. Back to levels that we were in 2021. Right around that 160 to 180 looks very attractive, down from around 265. And here's a short-term chart. They almost look exactly the same, both Lowe's and Home Depot. But I think those are stocks you want to keep an eye on because if housing slows down, I think you'll see a lot more remodels, a lot more people kind of upgrading their homes. And we've seen this trend kind of go back and forth for the years as people stop moving out. They do a lot of home improvement. So that's an area, in my opinion, you want to keep an eye on. Looking ahead, also fixed income, I believe, bonds, if you will, continue to fall, and you really want to be avoiding bond ETFs. And you know, I've always talked about this. There's an inverse relationship between interest rates and the price of a bond. As interest rates increase and go up, which they have, the value of a bond goes down. And the reason for that is because that bond right now, say you locked in at 2%. I'm just using a number here, and now you can buy a very similar bond for and get 3.5%. That one at 2% is worth a lot less because I can buy the other. So yields go up, prices go down, it's worth less. And here's a chart of TLT. And I've shown this a lot. This is the iShares ETF that tracks the 20 plus year treasury bond. And, you know, hit a high of around 155 in December. We're down to 111 now. It's below 110 about a week ago. And if interest rates keep going up, this will continue to go down. And what I've always done when I used to manage money at Penn Financial Group, my old investment firm, if people wanted fixed income, and I would put people in fixed income, even in times like this, you buy individual bonds because if you buy an individual bond that has, let's say, a yield to maturity of 3.5%, 4%, you're going to get that no matter what. The bond price will go up and down, but as long as that bond doesn't default and that company behind it doesn't default and continues to make its biannual payments, you still get your par back at the end and you get that yield to maturity. And you get that 3.5%. You're not worried about a basket like this, where with TLT, so bond ETFs, bond funds, I've been saying this for months, folks, and they keep falling. Stay away from them right now. I think this trend continues into next year. Another trend, I think, is that inflation is very, very near, if not at a top right now. Energy prices have been coming down. Food prices have been coming down. Metals prices have been coming down. I talked about copper yesterday in my daily email. And if you have not yet got the daily email, I do my daily digest. Please sign up for it. It's absolutely free. Every day the market's open, we put out a digest. We take two headlines and break them down what they need for you. My team and I put a lot of time in this, and it's absolutely free. Nothing. We don't ask you for anything else but your name and your email. We'll get you signed up for that. So please make sure you do that. But I talked yesterday about that, how commodity prices have been coming down a bit, and specifically copper. Copper hitting a one-year low last week. And copper is a very important input into basically anything that's electrified, building houses, everything, you name it. So copper is important. That's coming down. I think you're going to see inflation start coming down this next year. And I know people still love energy stocks, and I'm 50-50 on energy stocks here. Um, I want to say avoid them, but I think it to be very, very specific when you're picking energy stock. And they're not all going to go up like they did in the last 6 months, basically in the last year. Another thing to keep an eye on is midterm elections coming up in November. And history tells us midterm elections, after a new president comes in, typically the opposite party does very well. Obviously, Joe Biden's a Democrat, so that would mean that the Republicans do well. And everything's pointing right now to the Republicans doing well moving forward. So that's something that we want to keep an eye on here as well. Going forward. And one more thing to take a look at going forward is I think the stock market's setting up for a huge rally. I think with the second half is going to be huge. I think it's going to be blow people's minds at how much gains we see. I'm about to show you here two important charts that are going to make the complete difference for you. So here's the first chart I want you to see, and this comes from LPL. And this blew my mind when I saw it. This looks going back to 1932, believe it or not, going way back. And since that time, or it goes back to 1928, but the first time this happened was in 32. Looks at times where the S&P was down at least 15% at the end of June, so in the first half of the year. Right now, we're down about 19%. So I don't see us rallying enough to get out of this category. So as you can see in this chart, 32, 39, 40, 62, 70, and 22, which is this year. It's showing 21, but again, we've bounced in the last couple of days, so it's actually around 19 right now. So every time prior, all 5 times, look how it ended the next 6 months. Every time it was up, an average of 23.7% and medium of 15.5. That is absolutely fascinating. And I think this trend continues. Again, this goes back to nearly a century, folks, and has not happened very often, but when it has, boy, oh boy, did you see a huge rebound. The other chart I want to show you is it's looking at just quarters. So we're looking at the quarter, and right now we're down just about 15% in the quarter. So we're very close to this, but let's assume it closes down 15%. And this shows when the S&P has a quarter going back to 1950 of at least a 15% decline. You can see here it's happened several times, 7 times in the past. If we look ahead 2 quarters, I'm looking at the rest of the year, every single time it was higher, an average of 17.1, medium 15.3. So the average of those 4 numbers I showed you, the medium and the average of the quarters and of the first half of the year, the worst is 15.3. That's a big gain. That's nearly double what the market averages over the last century. And to see that in 6 months, and again, 100%. 1 quarter looking out, it didn't work in 08. And I don't care about 1 quarter. But more importantly, folks, look out 1 year. 1 year later, all 7 times, the average of 29.6 and the median is 26.7. So the history shows us when we have these crazy times, it's not unprecedented to see big rallies. And I have to tell you, it comes down to the numbers. I am a numbers geek, so I play numbers, and that's how I invest. I invest on odds. The odds are the market should rally the second half of the year into next year. That's what it says. I don't care about the headlines. Do you think the headlines were good back in 2008 at the end of the year? No. I was working in Manhattan, going on Fox News, Fox Business every day. People were freaked out. I'll never forget it. Don't forget in March of 09, the day the S&P at 666 intraday low, I put out a portfolio and said, you need to buy today. That exact day. Sure, there's luck involved there, but I did it. And I've been there. And I look back on this. 2002 was a time prior. I was there then. I was working for Charles Schwab in Denver at the time. I remember the phone calls I was getting. Nothing was positive. It's not like people are saying that time, boy, we better buy. Things are going to be great in the next 6 months and the next 12 months. No. So right now, the way you feel is normal. But again, history shows us when we're like this, this is what happens. So one more reason that I'm bullish. I saw a stat that came out from Jefferies this week. It's an investment firm, research firm. The tech large cap growth funds, the mutual funds, and that's a large portion of them, or I shouldn't say tech, just large cap growth funds, mutual funds, are the most underweight tech ever, ever. They're underweight by 9.1%. On the flip side, materials are the most overweight ever at a positive 0.7%. And this is kind of fascinating too, and this is why I hate mutual funds. It's 80-20 rule, right? 20% are good, 80% stink. Only 24.7% of them are beating the Russell 1000 Growth Index, and that's the 100 largest growth stocks in the U.S. And the average fund's lagging by about 2.2%. So this really shows that, again, I see a turnaround here, especially for some tech stocks. When you're this underweight, folks, it typically is a time that you want to see money come back in. These large cap growth funds will not stay overweight this. They will rotate back in. And when they do, that's big, big money will come into these stocks, these growth stocks, these tech stocks. And you're going to see a bounce, I'm telling you. So again, the numbers show us when we have horrible starts to the year, when we have two horrible quarters in a row, when we have one horrible quarter, as we showed in the last chart, typically the market sets up for a rebound. And it's not just what they call a dead cat bounce, like we've maybe have seen a few times this year, where it rallies and it hits a new low, the downtrend I showed you. It's not necessarily that. I showed you 2 quarters out and 4 quarters out. That's a year out, an average gain of 29.6%. This is big looking out. The year's still short term, but it's not a dead cat bounce for a year. So please don't get wrapped up in the negativity that's out there right now, because it is absolutely draining and frustrating. You ask somebody how they're doing these days, and it's never a smile. It's disheartening. It makes it tough to even talk to people. I try to be the cockeyed optimist that I am, but sometimes it's even hard, but I do my best. All right, next thing I want to talk about is the financials. And I don't talk about the financials that often, but the more research that I've been doing, again, looking back in history and trying to determine other times like this and what has done well. And historically speaking, in a rising interest rate environment, which obviously we're in, financials do well. And the reason for that is their net interest income increases. And what that means is they borrow money from the Fed, and then they lend it out to you. As interest rates go up, they cost them more to borrow, but they charge you more to borrow. So that spread becomes bigger. The bigger that spread is, the more the banks make. I know that probably irritates you and gets you pissed off a little bit, but one way to stick it back to demand is own the stocks, because they should do better at the same time. But they have not been doing that well this year. And the reason for that is people are concerned that we're going into recession. So we go into a recession, I think the banks are going to struggle. And it makes sense. And the banking index is actually down this year. I think it is down, looking right here, about 24%, believe it or not. 24% year to date. The KBW banking index, 24%. So it's lagged the overall market, which is very, very surprising to me. So I went back to 1994, folks. Again, the year I graduated. You know, my graduation night, after graduation, we all came back to my house, had a lot of fun, had a party, and there's a lot going on. I think it was Game 7 of the NBA Finals, if I'm not mistaken. The Knicks were in it, and they ended up winning. And there is also another thing going on, this white Bronco. That was the OJ chase, the night of my high school graduation. So people were fighting which TV to put on the NBA Finals and which one to put on the OJ chase. So it was quite the evening. And that was even the highlight of the evening, but it was quite the evening. So February of 94, the Fed started raising interest rates. They raised it by 25 basis points on February 4th of 1994. They went on then to continue raising. They raised another 25 in March, another 25 at an emergency meeting in April, 50 in May, 50 in August, 75 in November. It's the last time they ever did the 75 until recently. And then they did 50 again on February 1st, 1995. By July, they were lowering interest rates. So the Fed funds rate went from 3% to 6%. It basically doubled it in that time frame. And that was Alan Greenspan that was doing that, if you remember Alan Greenspan. So they raised it. So very similar situation we see here. But what's crazy is during that time frame, inflation really wasn't that high. It was only around the average of the inflation in 1994 is about 2.6%, not where we are now. So that is the one difference I'll throw in there. But if you look at how bank stocks did in that time frame, they actually did very well. Schwab was up huge in the 12 months after February, that rate hike, and a couple other of them did really well as well. So I'm going to take a look at actually five stocks here in the banking area that I believe could potentially be setting up for a nice bounce. First one is Charles Schwab. I just mentioned, symbols SCHW. You can see here, stock fell from nearly $100 down to 60. It's at 65 now. But let me show you the longer term chart. And boy, right here is huge support in 2018. And if you go over there, it's at 60. That's where it just bounced off. I think Schwab looks really, really good here on that pullback. Schwab continues to grow. It bought obviously Ameritrade in the last couple of years. And I think there's big upside for Charles Schwab. We'll take a look at one that's kind of a bit different, and you probably never heard of this one, even though I think I may have mentioned it in the past on the show. This is Signature Bank. The symbol is SBNY. This is a New York-based bank. They have some ties to crypto, and that's why I think maybe it's gotten hit so much. Not huge ties, but some ties. And it's $11.8 billion bank, so it's a decent size. But they get a lot of the revenue from commercial business. They also do a bunch of niche specialty lending as well in banking. So it's not your traditional bank, in my opinion. But earnings per share last year, $15.03. This year, looking for $22.03. That's a huge gain. By 2024, looking for nearly $30 a share. Revenue in the same time frame, $2 billion last year, looking for $2.88 this year, up to nearly $4 billion by 2024. So in a matter of 3 years, doubling revenue and basically almost doubling the bottom line as well. Again, in a matter of 3 years. Pays a small dividend, 1.17%. You're not buying it for that. You're buying this for growth. So a stock like this, I see, and it's just really, really attractive. And again, if you're looking at where it's trading at, 195 right now, and you have earnings per share this year coming in estimate of 22, you're trading at less than 10 PE ratio. With that growth, this is a cheap stock down here for me. Another one going from that coast to the East Coast to the West Coast is SVB Financial Group, SIVB. I may have talked about this in the past. Basically, it's Silicon Bank is what it is. Silicon Valley Bank, I should say. It's a global commercial bank, but they have a couple divisions. They have global commercial, they have private banking, they have capital markets, and they have securities as well. It's a $24.2 billion company, so about twice the size as Signature Bank. Earnings per share last year, $31.25. This year, looking for $35.76. Looking at to 2024, over $50 a share. So trading, based off even this year's, you're trading at about 12 PE ratio, so kind of low. Revenue last year, $5.91 billion. This year, looking for $7.2 billion, and about $9.85, nearly $10 billion by 2024. Again, trading about 2 times sales, little over that based on 2024. Again, this pullback from 760 down to 400. And let me show you the long-term chart of this because it's a fascinating chart. I mean, this stock going back was less than $100 in 2003, went up to 750. Big pullback. Lots of support around 340. Maybe it pulls down to there. I don't know. But I will say that, anywhere in that range, this looks like it's something you want to add to the watch list. Again, nothing here buy or sell recommendation. But again, keep in mind, it's something we want to keep an eye on. So the next one is we want to take a look at is JPMorgan. And JPMorgan fallen as well from about 175 down to 110. We're back up to 119 here today. It's about a $355 billion company. They have nearly $4 trillion in assets. Their earnings per share last year, $15.30. Theirs are a bit different. It's expected to dip because IPO and taking companies public, as I mentioned, down to $11.36 this year, but by 2024, back to $13.79, so working its way back up. But even based off this year's earnings estimate, trading around 10 PE ratio, revenue similar, 121 last year, but it's going to increase a bit, 126 this year, 2024, 140. But it has low valuations. It is a very undervalued stock for being so large. The last one I'm going to show you is Citigroup. And Citigroup hit a high all the way back in June around 80. It fell to 46, so nearly lost half its value. It's a $93 billion company. Earnings per share last year, 10.14. This year falling to 6.81. By 2024, 8.23. Revenue last year, 72 billion. This year, 73, 76 by 2024. So this one doesn't have the growth. However, Citigroup trades at 50% of its book value. So half of its book value. What book value is, folks? You take the company's assets, you minus the liabilities, and that's what's left. That's the book value, what you can basically sell it off for. 50% of that. So people are pricing in a deep recession and issues with Citigroup that things are going to blow up, in my opinion. Just getting back to where you need to be at just trading at flat book value would be a double from here. Would be a move up to nearly $100 a share. And again, it topped out at 80 last June. So I think it's tough to ignore the financials. I'm going to keep doing my research on them. I'm personally underweight financials, so I'm thinking about maybe adding some. And for our subscribers, obviously, you come, first, looking at some financials for you as well. So I think you want to really, really start thinking about this. And you have to ask yourself, if you want to have exposure to financials and you don't now, what better time do you have? If you have a 3-year time horizon, I think you'll be extremely freaking happy. And probably in a year from now, with a lot of financials I just mentioned. Again, not a buy or sell recommendation. These are just ideas to educate you, put on your watch list. But I think it's something that you cannot ignore right now. So before we wrap the show, we're about 20 minutes into trading right now. We'll take a look. S&P 500 up another 1% here at about a 2-week high. So the market continues to look good. The market continues to get buyers coming in. And I don't see that really stopping wholeheartedly anytime soon. But again, we're at a very important level, folks. We need to watch this 390 to 400 or so level on the SPYs. If we can break through that, that's great news. I don't think we go straight through it, but at some point, I think we will in the next month, and I think that's going to be really good news. But again, if I'm wrong, I still think it's about a 30% chance we could hit a new low if it fails at this really important level that's sitting at right now. So keep an eye on that and make sure you look into these financials. And if you want more in history, look back in 1994. It's a very similar time what Greenspans did back then and what we're seeing Fed Chairman Powell do right now. So history does repeat itself, folks. So thank you so much for watching. Don't forget to like, subscribe, comment on the show, share it with your friends. But thank you so much for the support. We'll be back Thursday right here in the home studio. I look forward to that. Until then, I hope you have a really great week. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.